Welcome to the recorded workshop session for the Accounting Distance module.
Hello everybody, my name is Kwena Maseko. That's my name, so I'm going to be your lecturer for accounting. So if you need anything, please do not hesitate to contact me. My number is 072 610 6621, and here is my email address is ksema0018@gmail.com. All right. So the objective of today's class is basically to address two important things. All right. Some of these questions have been included in your assignment. So we just want to make sure that you can be able to answer those assignments. All right. So here are our two objectives. Number one, we're going to learn about the accounting equation. All right. So in other words, after this class, you should be able to process the transactions on the accounting equation. And the reason we start with this is because it is the foundation of accounting. If you master these accounting equation, you are not going to have a problem at all. All right, so I want you to pay very careful attention. All right, and we will also be learning about the subsidiary journal. In other words, processing transactions in the accounting records. All right, so we're going to record transactions in the accounting records. All right, so these are the two things that we're going to do. All right, our magical accounting equation is as follows. We say assets are equal to equity plus liabilities. Right, so the first thing is to understand what these animals really are. All right, so equity, we actually say it's the owner's interest in the business. That's what equity is. It is the owner's interest in the business. Right? And the assets, we call them the possessions the business has to generate income. So assets are possessions of the business used to generate cash. All right, and we get to liabilities. Liabilities are basically all the obligations of the business. So these are all obligations of the business. So this is what the business will need to pay out eventually. All right. So this accounting equation basically makes sense because what happens is to start a business, you basically will need to get some capital. All right. You need some money. You can't start a business with nothing. All right. That will be your equity. All right. So we call it capital. All right. So under equity, one element of equity is called capital. All right. So that is the first element of equity, is capital. So capital is the money or funds that you use to start a business. All right. So funds used to start a business, contributed by the owner. All right, so that's what we call capital. All right, so the owner will get capital. Say the company is going to need 500,000 to start. So the owner must actually source that capital. So if he has 500,000 and he's going to use it to start or expand his business, we're going to call that capital. All right, but sometimes it so happens that the owner does not have all the money to start a business. Let's just say the business will require 1 million and the owner will actually have 500,000 only. So what will have to happen is that the owner will have to borrow some money, all right, and he has to incur some liabilities. He needs to go to the bank and say, you know what, I need to start money to start a business. It needs 1 million. I only have 500,000 and I'm asking you to lend me 500,000. All right. So that we will call it a liability. But liabilities have got two categories. The first category of liabilities is called non-current liabilities. Non-current liabilities. Whenever you see the word current, remember we are talking about a period of 12 months. So we are talking about a year. All right. So when you see the word current, think 1 year. All right. So when we say a liability is a non-current liability, basically we mean that that particular liability is repayable over a period exceeding 1 year. All right. That's a non-current liability. So non-current liability, it's payable over a period greater than 1 year. All right. So if you borrow that 500,000 from the bank will say, please, we want you to pay it back to us over a period of 5 years. All right. So can you see that the period is actually exceeding 1 year? All right. So that's why we're going to call it non-current liability. All right. What are examples of non-current liability? What are those obligations that you may have to pay over a period exceeding 1 year? All right. One example of that is a mortgage loan. It's a mortgage loan. So a mortgage loan, it's a loan that you get specifically to acquire property. All right, that's what a mortgage loan is. All right. So if your parent has bought a house, by getting money from the bank, we say they've got a mortgage loan. All right. So your typical mortgage loan is payable over a period of 20 years usually. All right. So that's why we say it's a non-current liability, because you're going to have to pay it over a period exceeding 1 year. All right. Or we can have what we call a long-term loan. All right. We can have a long-term loan. So a long-term loan That's a loan that you get to purchase a car. If you go to the bank and you say, can you please help me to buy a car? They'll give you a long-term loan that you'll have to repay over 5 years. It's either 60 months or 72 months, all right? So can you see that 5 or 6 years are a period exceeding 1 year? That's why we call it current. So if we say an item, it's a non-current liability, we are saying it's going to take you more than a year to actually repay it. All right. So that's what one type of liability is. All right. So we need to go to the other type of liability. All right. Let's go to a new document. All right, let's go to a new document. So we're just finding our way. I want to save. All right, so we're saving our lovely document, all right, because we want to be able to get back to it. All right, so we're still getting comfortable with technology. All right. All right, so let's just wait for it for a bit, so we should be able to save it. So it is saved. All right, so we can all right, so let's save it. So we're going to save it as the accounting equation. All right, so let's save it as the accounting equation. Accounting equation. All right, so let's save it. Here we go. So it is saved. All right, so we're going to go to our new document. All right, so we've got our new document here, so we're just carrying on. So remember, we are busy talking about the accounting equation, which is your assets equals to owner's equity plus liabilities. All right, so remember the liabilities we were talking about. We were talking about non-current liabilities, and those are liabilities which are taking you over a period of more than 1 year to actually repay. So make sure you remember that. Don't you forget that. All right, so we get to the second category, and we call that current liabilities. Can you see the difference? All right, remember the magic word current. What did I say you should remember when you see the word current? We're talking about 1 year. All right, so current liabilities are basically the opposite of non-current liabilities. So these are payable within a year. Okay, so your non-current liabilities are payable within a year. All right, so we're paying our current liabilities within a year. What are examples of current liabilities? All right, here are our examples. All right, our creditors, our suppliers. All right, so the examples of our Non-current liabilities are our creditors. And creditors are actually suppliers from whom the business purchases goods on credit. All right. So these are parties from which business purchases goods on credit. On credit, all right. So if we have suppliers and we can buy goods from them on credit, not for cash, these people become our creditors. And you can see why they are classified as current liabilities, because the supplier is not going to wait for more than a year for you to pay. All right, so that's why we say it's a current liability, because they will give you 30 days or 60 days to pay. All right, and another liability will be called, we have here is bank overdraft. All right, we call it a bank overdraft. What is bank overdraft? So simply put, your bank overdraft is when you have reached a balance of zero. You no longer have money, but the bank allows you to continue withdrawing. So once you reach zero, any amount that the bank allows you to withdraw is called bank overdraft. All right, so if you have a bank overdraft and you're working, so what's going to happen is when your salary comes in, it must first pay the bank overdraft. All right, they're going to take the money you owe them first. All right, we say it's current because the bank is not going to wait for more than a year for you to actually settle your bank overdraft. So it's a current liability because it's payable within a period that is less than a year. All right, and we've got VAT. All right, we call it VAT output. We call it VAT output. So VAT output is VAT that comes when we are selling goods. All right, when we sell goods, all right, if our item, for instance, is sold at 114, the VAT amount in that 114 is actually 14 rands. All right, I'm going to show you this calculation when we deal with the VAT sections. All right, but I just want you to understand what we mean when we say VAT output is a liability. All right, so the VAT of 114 is actually 14, which is basically 114 over 14 times 14 divided by 114. So that's a 14. So this VAT amount is not yours. So when you include VAT in your prices, that VAT is not yours. You are collecting it on behalf of the taxman. All right. So once you have collected that VAT, you have an obligation to pay it over to the taxman. All right. So you have a liability. You have an obligation to pay it over to SARS. And according to our VAT Act, the VAT can be payable on a monthly basis or on a bi-monthly basis, or we can pay it half yearly. All right. There's different regulations that SARS has. But what is definite is that there is no VAT regulations that say you have to wait for more than a year to pay your VAT. So you can pay it monthly, you can pay it bi-monthly, but all that period falls within a period of 1 year. That's why we say it's a current liability. So I'm sure you are very clear about what a current liability is and what a non-current liability is. So that's very important. All right, so let's go back to our first slide. All right, because we are now done with what liabilities really are. Because when we are dealing with transactions and we come across liabilities, we are going to put them here. All right, we're going to put them in the liabilities category. So if you know what liabilities are, you are not going to be confused. All right. So that's my aim, is to make sure that you are clear. You are not confused. All right. So let's come to assets. All right. Think about it. Once the owner has contributed capital and he got some loans from the bank, what does he do with that money? He must actually purchase assets. You see, there's a logical connection. The owner brings in capital, and then if he doesn't have enough, he goes to the bank and say, can you borrow me some money? Once he's got that money, he must actually purchase the assets, all right? Because those assets are the ones that are going to generate cash, all right? So let's say you are starting a delivery, a transport company, all right? So you need to contribute your capital, get some loans if you need to, but then you must buy those trucks, all right? Because if you don't have trucks, you are not going to be able to generate cash. So you get your assets to generate cash. So just as we have non-current liabilities and current liabilities, even in the assets category, we have non-current assets and current assets. I'm sure you already know what non-current means, and you know what current actually means. All right, so let's have our current assets here. Let's just start with our non-current assets. All right, so let's start with our non-current assets. All right, so our non-current assets will be similar when it comes to the period involved. We say our non-current liabilities are those liabilities payable over a period exceeding 1 year. So when we talk about non-current assets, we are talking about possessions of the business that can be held for more than a year. All right. So here we are talking about possessions of the business that can be held all right, I'm just going to continue here, for more than a year. All right, so the common denominator between non-current liabilities and non-current assets is a period greater than a year. All right, what are the examples of non-current assets? All right, I can hear already you saying vehicle. All right, so if you've got a car, it lasts you for a period more than a year. All right, what about a chair? All right, you see, that's what makes accounting easy, because sometimes you are sitting on the answers. All right, we call that furniture and fittings. All right, so the common thing between this, all right, is that they can last for more than a year. All right. What about equipment? So that is actually the board I'm using here, the equipment that we're having here. All right, so this equipment can be used for more than a year. All right, so we'll have equipment here. So this will include your softwares, your computer softwares, as well as your equipment will be your laptops. All right, your computer softwares, we call them intangible assets. All right, so we have items such as your vehicle, your furniture and fittings, your equipment. What about land and buildings? This structure that we are sitting in. All right, that's nice thing about accounting. You are sitting on the answers or in the answers. All right, so we've got land and buildings. See, I told you accounting is very easy. All right, so these are examples. So the common thing amongst these assets is that they can last for a period exceeding 1 year. Hence, we call them non-current. Remember, current means 12 months. All right. So we have the examples of non-current assets, and we can go to the current assets. So our current assets then are similar to our current liabilities. All right. So these ones can not last for more than a year. That's the difference. So these assets, they can't last. For more than a year. All right? So we need examples of those. All right? So we're going to have your trading stock. All right? Other people call it merchandise. Or other people call it inventory. All right? So imagine if Pick n Pay had to keep milk for more than a year, and you go and buy that milk. I can tell you, if I bought that milk, I wouldn't be standing here. All right, so we call it a current asset, all right, because it must be moving. It must not be keeping it too long in the business. All right, and then we have debtors. All right, you already heard about creditors. We say creditors are people that we owe. So we bought something from them on credit, and we're going to have to pay them, settle that account in the future. So debtors are people who are owing us. These are customers to whom we have sold goods on credit. All right, so let me repeat. So these are customers to whom we have sold goods on credit. All right, so they are just the opposite of creditors. So a creditor, you need to pay. The debtor needs to pay you. All right, and then here under our current assets, we have what we call our bank. All right, so the balance at the bank does not stay the same. It changes almost every single day because we withdraw some money, we deposit some money, so the balance will be changing all the time. So these are the examples of our current assets. So we are pretty much covered about the liabilities. We are pretty much covered about our assets. So now we need to fill up the blanks here on owner's equity, and then we have a fully fleshed picture after that regarding what these accounting equation elements really are. All right, let's go back to the first document. All right, so here we basically are saying in summary, as a businessman, you contribute your capital, and that's your equity, and then you can combine it with some liabilities to get your assets. Then they start generating money for you. All right. So as a businessman, sometimes it happens that, you know what, you want to take your family on a holiday. Your wife and children have been working so hard for you. All right. You came back tired and your spouse massaged you. And you decide, you know what, I have to reward my spouse. Let me take my spouse on a holiday. You withdraw 20,000 from the business. We call that drawings. All right, so that's a second element of equity. All right, so we call that drawings. All right, so what is drawings? Drawings is whenever the owner of the business takes the resources that belong to the business for personal use. All right, so the owner takes the resources that belong to the business for personal use. All right, so if you withdraw 30,000 rand from your business, it is not your money, it is the money that belongs to the business. So if you are taking that money for personal use, we call it drawings. So the key word here is personal use. The key word here is personal use. All right, because as the owner, sometimes you use the money, the funds in a business to maintain the business vehicles. So that is a business expense. It's not a personal use. So, but if you take money to use for your own good, as the owner, we say it is drawings. All right, because it belongs to the business. You are taking it out for your own pleasure. All right, so that's what we call drawings. All right, and then what happens? So you bought the assets and you have the trucks. They're delivering goods for your business to the customers. And what will customers do? They're going to give you what we call income. You're going to generate income. All right, so this is the third element of equity. All right, so we call it income. So we are already talking about the third element. We have spoken about capital, we have spoken about drawings, and now we are talking about income. All right, so there are many sources of income. All right, we can get our income from selling goods, isn't it? So we can get our income from selling goods. All right, that income is called sales. All right, we will call this sales. But as business, we may not only get income from selling goods. All right, we can invest money at the bank and get what? Interest. All right, so we can get our income also from our investments. All right, investments. So if you have cash at the bank, that could be interest. We call it interest received in accounting. All right, what if you have invested money by buying shares? You get the income called dividends. All right, so from investments we can get interest, or we can also get dividends. All right, so these are really our sources of income. All right, the other source of income from your investment is sometimes you can actually own a property and lease it to someone. What are you going to get? Rental income. All right, so that's also your income. All right, so you can see that basically then what we're doing effectively is we are using these assets to actually generate this income. All right, because these investments will be our assets here. These are our buildings in here, and we are using these assets to actually generate income. You see, we said inventory or merchandise is part of our current assets. So we are actually selling them to generate what we call sales. So your income is generated through your assets. All right, so that is the third element of equity. And the last element are your expenses. All right, so you can't get income for nothing. You have to incur some expenses. What about the driver of your trucks? All right, he needs some salary. All right, so we can say really expenses are incurred to actually generate this income. All right, so your expenses here will include the salaries and wages, all right, of your employees. All right, the trucks will need to be maintained. So what will we need? Fuel. All right, we're going to need fuel. All right, we may have to take them for maintenance. All right, and what about when you order goods from your suppliers? Telephone expenses. But for those telephones to work, you need electricity. That's your expenses. and the municipality wants you to pay the rates and taxes. So your rates and taxes. So the number of expenses are just numerous, all right? There's a lot of them. But the common thing about them is that these ones, really you incur them on the day-to-day running of the business, all right? They make it easier for you to generate income, all right? So I just want us to particularly pay attention to equity, all right? Let's pay attention to equity, all right? We say we have capital. So if you contribute money to your business, what does it do? It increases your equity. It's a plus to your equity. But if you are taking money from the business, it's a minus. Something is going out of the business. So this one has got a negative impact on equity. So capital has got a positive impact because you are putting in money. Drawings, it's got a negative impact because you're taking out money. All right. So let's go to the two other elements. When it comes to income, so it is coming into your business, it has a positive impact on equity. All right. And when it comes to expenses, something is going out of the business. All right. This one has a negative impact on equity. All right. So this is really what the elements of accounting equation has. So I hope by now you are not confused as to what an asset is, as to what owner's equity is, and as to what liabilities is. All right. So let us just recap. All right. We say this is the foundation of accounting. All right. Developed centuries ago. All right. Our father of accounting, we call him Lucas Pacioli. All right. Is the friend of Leonardo da Vinci. All right. So if you master this one, we can say you are also friend of Leonardo. All right. That should make you very proud. All right. So this is our accounting equation. It is the foundation of accounting. All right. So we say, as the owner, you come, contribute some money, combine it with liabilities to get your assets. And we say assets have got two categories, non-current and current. And liabilities also have the similar categories, non-current and current. And when it comes to owner's equity, it has four elements. First one is capital, the second one is drawings, the third one is income, and the fourth one is expenses. And we're saying capital increases your equity, drawings decreases your equity because you're taking something out, income increases your equity, and expenses decreases your equity. All right, so that's what this accounting equation really is all about. So this is an equation. So the way accounting works, equation works, is that the left-hand side must always be equal to the sum of the items on the right-hand side. But we're going to come to that later. All right. So what we're going to do now is we are going to save our notes. It's very important to save our notes because we can always go back and refer. All right. And we are just going to go through an example. All right. In your question book, that will be 2.6. All right. So I have it here. All right. So what you can do is, all right, just pay attention because that question has got all the items listed, and what we need to do is to determine whether it's an asset, whether it's an owner's equity element, or whether it is a liability. So basically that will reinforce our understanding of the elements of owner's equity. All right, so let's just save it. So it's All right. So anyway, let's just go to the document. I think we can find it. We can find it. Oh, here we go. We just found it. Fantastic. Fantastic. We just got it. All right. So what we already have here, can you say you remember non-current assets? We spoke about them. You remember them. Current assets. You remember current assets. And non-current liabilities. You remember them. And we've got current liabilities. All right? You remember them. Your income and expense. And here is something strange. Proprietary account. All right? I can hear you say you didn't speak about them. All right? So my friend, I just want to confess I didn't. All right? But I'm going to help you. We have already spoken about it, but we did not use the word proprietary accounts. So basically, when you see the word proprietary, it talks about capital and drawings. All right, that's what proprietary actually means. So when we say talk about proprietary, we are talking about those transactions involving the owner of the business. All right, so the transactions really involving the owner of the business is when he contributes capital to the business. And when he withdraws money for personal use, that's really the only time when the owner is involved himself in transactions. All right. All right. So don't be confused. When you see proprietary account, know that they are talking about two things. All right. So let's classify our accounts. All right. Here we got wages and salaries. Remember, can you guess where it belongs? Non-current asset. I hear you grumble. All right. You say, no ways, that is definitely an expense. You are right. You are right. So it is our expense. So we can just tick there to show that we know the elements of the accounting equation. We know that our wages and salary are actually expenses, trading inventory. All right. So you remember what trading inventory is? So I can see that you are actually saying, I know it is an asset, but the question is it a current or non-current asset? All right? Do you remember what current means? What non-current means? All right? What do you think? All right? It is a current asset. All right? Remember my lovely story about milk. All right? So you can't keep it for more than a year. All right? So you have to sell it quickly. We call it trading inventory. All right. So bank overdraft. All right. We spoke about bank overdraft. Is it an asset? No. Definitely no. I can see you shaking your head. All right. Is it? I think it's something like a liability. But what kind of liability? All right. The question we ask ourselves is, if we have bank overdraft, how long will the bank be prepared to wait for us to pay it? Will it be prepared to wait for more than a year? No ways. They want you to pay it quickly, the moment you get your salary. So it is a current liability. All right, so we can put our tick there. All right, so we go to the second one, the fourth one here, which is our interest income. All right. So I can see you say this is too easy for me because they just said it's an income. So the only place where I see income is really here. And guess what? You're absolutely right. All right. So sometimes in accounting assessments, we are so generous. Out of love for you, we just give you a tip. All right. So that's your income. We can tick here. All right, settlement discount granted. So I'm hearing about this for the first time. What is the settlement discount granted? All right, so it is settlement discount granted. What is it? All right, sometimes what happens is your debtor, someone who owes you, all right, usually will need to settle the account after maybe 30 days. But because you want to encourage debtors to pay quickly, You say, if you settle your account, if I have given you 30 days, but you say, you know what, I want to be the best debtor ever for you, all right, so I'm going to pay mine within 10 days. As a business, you can say, if you're owing me 1,000 and you decide to pay me earlier than the due date, I can give you a settlement discount of 100. So in other words, instead of paying 1,000, you pay 900, all right? You got a settlement discount of 100 rands, all right? That 100 rands, we call it settlement discount granted, because to grant is basically to give. So as a business, we have given our obedient debtor a discount, all right, because the debtor has paid us early, all right? But you see, we are losing something, because really we were supposed to get 1,000, but then we let the debtor get away with 900, all right? So we are losing 100 rands. That 100 rands is actually an expense, all right? So it will come under here, an expense, because we have lost something we were supposed to get because we want to be generous to our lovely debtor. So interest on overdraft, all right? So you see overdraft here, all right? So which means this is really the interest that you pay on bank overdraft, all right? So if you withdraw 20,000 below zero balance, so you're owing the bank 20,000, but the bank says, all right, because we have borrowed you money, you must pay us interest. All right, so if you're owing overdraft, the bank will charge you interest on the bank overdraft. All right, so this becomes an expense as well that you have to incur. All right, so it will come under your expenses. All right, so we come to the capital. You remember capital? All right, we spoke about elements of equity. We said capital is number one, followed by drawings, and then we have income and expenses. So we know that capital is an element of owner's equity. But you remember what I told you at the beginning? I told you that proprietary accounts includes both capital and drawings. So you already know where it actually belongs, because I've already given you the answer. So our capital will actually come to the proprietary account. All right, so let's move on to the next one, mortgage loan. All right, we spoke about mortgage loan. What did we say mortgage loan is? All right, you just remember that we talked about the house your mom got, all right? You have forgotten about where the mom got it and under what terms. All right, we said a mortgage loan, it's a loan that you get exclusively to purchase property. All right, and then we said it's a non-current liability because the bank will give you about 20 years to actually settle the mortgage loan. So that actually comes under non-current liability. All right. So we come to our creditors control. Our creditors, remember we said our creditors are the people that we owe, all right? They have supplied us with goods on credit and we need to pay them, all right? How long will your suppliers be prepared to wait? For more than a year? No. So that makes it a current liability. So our tick will be here. And then we come to our rental income. I told you that in accounting, we are generous. We just give you answers. You've got income here, you've got income there, and then you know where it belongs. So the income belongs here. All right, so let's just go down. So let's just go down. All right, so we'll get it right. All right, how do we go down? All right, so this will increase it. Okay, let's try here. Okay, so let's try here. All right. All right. All right. So let's just sort out our problem and we will just continue in a moment. All right, so we continue and finish off, continue where we left off. So we just erase this. All right, because I can see you have been diligently taking this. All right, so we're just going to move down. So you can remember that we ended with our rental income. All right, so we are coming to the cost of sales. So we come into the cost of sales. So our cost of sales, what will be our cost of sales? All right, remember our headings. All right, I'm just going to repeat our headings. I'm just going to make it easier for you. All right, so because we are just continue from where we left off, we can just insert our columns. All right, so that everyone is on the same page. We don't have to be scrolling up and down over and over again. All right, so let's just copy that. All right. Okay, so here we go. So we can just paste that. Here we go. So let's just paste that. Okay, but we know that this one belongs. So we can just cut that. And then we can just paste from here. Okay, let's. All right. Okay, so we just gonna copy this. Just this. All right, so let's just copy them, and then let's paste them from here. Okay, so all right, I'm just going to do this. All right. All right, so what I'm going to do is I'm just going to put an arrow. I'm just going to put an arrow to say your non-current belongs here. All right, so our non-current all right, so let's get rid of this. So let's just say, because we have it, we can make it easy. Let's try and make our job very easy. If we just insert the cell below, all right, we can just say all right, so we can say, okay, so this is not where I want to go. So let's just save what we have. All right, so we come to our savings account, so we know that these are non-current assets, so it looks like we have a bit of a problem. All right, so we got technological problems. Let's just sort it out. All right, so we continue. So now we get to the savings account. All right, so the savings account is that money you will have saved with a bank. So we are just talking about, when we talk about bank, it includes the savings account as well. All right, we said that it is your current asset. All right, it is your current asset. And what is your petty cash? All right, petty cash will be that cash which is used for minor. Hence they use the word petty, because petty means small. All right, for those small little expenses, petty cash, it's used. What are those things? Your coffee and tea. All right, we use petty cash to be able to buy those things. All right, but it's still cash. All right, which makes it a current asset. All right, because we buy coffee today, we need to replenish the petty cash so that we can be able to buy coffee tomorrow. Drawings. So you remember when you spoke about drawings, we said drawings and capital are proprietary accounts. All right, so we said drawings and capital are proprietary accounts because they are transactions with the owner of the business. So which means our drawings will go to the proprietary account. All right, our proprietary account is below. Okay. All right, so our drawings will then belong to our proprietary accounts. All right, and we move on to our land and buildings. We spoke about those. All right, we said the land and buildings are non-current accounts because we can use them for a period greater than a year. So we're going to put them in the non-current assets. All right, what about our office consumable? All right, what will be an office consumable? All right, that's like a strange word. All right, so this will be the ink for the printer. We will call that an office consumable. All right, so what will that be? Will it be an asset? Will it be an expense? All right, so this will be our expense because we use them to maintain our equipment. All right, so we have stationery. All right, our stationery will also be an expense. All right, staff refreshments. All right, so you see we use that petty cash to get the staff refreshments. All right, that's your like juice, your coffee, they are expenses as well. It's not on.
Otherwise it will be showing here. Did you press there again? Is it on there?
Yeah, here it's not on mute.
It's still on. You see guys, we've got no sound.
Yeah, it has no audio.
Now.
Is it on now? It's recording now, eh? I think it's on. Is it on? Oh, it has no audio.
No, because look, it's definitely on. Because yeah, this.
It must actually be recording.
Yeah. Well, I'm
Okay. So I can.
my mic, but your mic is open. It's going. I'm going to call.
Should I mute it in the meantime?
Muted, yeah.
All right, so let's continue. All right, so we say we've got savings accounts. So this is really the money that we have saved at the bank for the future. All right, so we said our bank is our current, so the savings account will actually be our current asset. All right, so we come to our petty cash. Our petty cash, what will be our petty cash? All right, the petty cash we say is that cash we use for our minor expenses, and that's our tea and coffee. All right, so the petty cash will then be a current asset because we buy coffee today, we need to replenish. If we used 100 rands, we need to replenish petty cash with another 100 rands, so the balance will be changing all the time. All right, so what about the drawings account? All right, the drawings we said, drawings and capital belongs to the proprietary account because we say a proprietary account is for the transaction between the business and the owner of the business. So our drawings will actually belong here. All right, what about office consumables? All right, our office consumables, an example of that will be an ink that we used for our printer. That is an office consumable, and that becomes our expense. All right, because we're using it to maintain our office equipment. And we can see we left off land and buildings there. I see that land and building is too easy for you. That's why I deliberately left it, because you know the answer. All right, so that answer is a non-current asset because you're going to keep it for a long time. What about stationery? So your stationery are your expenses, and so will be your staff refreshments. All right, advertising. Remember, this is the expense that you incur to promote your business, all right, to promote your goods, all right. So if you are selling Nando's, all right, you go to TV, someone eating, enjoying the Nando's, all right, so you incur advertising expenses. They are important for you to generate sales. So we said expenses are those expenses you incur for you to generate income. So it will be an expense. All right, so what about the credit card account? All right, so the credit card account means you are owing. All right, so if you take this credit and you add OR, you have a creditor, you are owing someone, so you have to settle the credit card balance. So it will come to your current liability. So this will belong here. What about your rates and taxes? So your rates and taxes, you pay them to your municipality every single month. All right, so you have to incur those expenses. They are necessary for you to operate. What about commission received? What is commission received? All right, sometimes as a business, you are an agency. You are helping people sell the property. All right, so someone comes to you and says, may you please just sell this property for me for 1 million. All right, and you help the owner sell that property for 1 million. So will that 1 million all belong to you? No, the owner will want most of it. In fact, the owner wants to pay you for your services. So the owner will say, I will pay you 5% of the amount that we get from selling the property. That 5%, we call it a commission. All right, so the owner is paying you for rendering services for him, so that will be an income, all right, for the business. And then we come to machinery. All right, you need machinery to produce goods. All right, so that will be your non-current asset, because if we buy a huge machinery, we're going to use it over a period greater than 1 year. So this will come under our non-current assets. All right, what about traffic fines? We have our truck business, and the driver is late for delivery. All right, he drives recklessly and he incurs a traffic fine, so that will be an expense. All right. And it is an expense that is just so unnecessary. All right. So we come to the long-term liability. All right. So the long-term liability, long-term loan, I've already given you the answer. All right. So it's a long-term liability because if you get a long-term loan, we're going to repay it over a period exceeding 1 year. All right. So that will be our non-current liability. All right. So that's great. So we've got just one more item, and then we will just take a break, and we will continue from there. All right. Let me just erase here so that we may be able to move down. All right. So I hope you find it interesting, just as I do. All right, let's just erase here as well. So it's just one more item, and we should be okay. All right. All right, here we go. All right, here we go. All right, so that's our debtors control. So debtors control, so it's our debtors control, it's our last item. So remember, here we've got non-current asset in the first column, and the second column is our current asset. So the debtors control, remember, these are the people that have to pay you money, but you won't wait for more than a year for them to pay you. So they will pay you within a month or 2 months. So that will make it a current asset to you. All right. So it will belong here. All right. So I'm sure after this example and what we have done before, you can clearly be in a position to actually explain what an asset is and give good number of examples. You can be able to tell what a liability is and be able to give examples. You can do the same thing for the owner's equity. All right. So let's just take a break, and we will continue from here. Thank you very much for paying attention. You are fantastic students.